All right.
Yeah.
Right, cool guys. So auditing, guys, there is a lot involved, all right, with regards to the audit process, of course. So for starters, let's just run through the framework so that we have an idea of what's happening with regards to auditing. All right, I'm just going to go through the whole cycle, then we look at some questions there. All right. So auditing now, all right, before we start to audit, all right, we need to assess if we should work with a client or not. All right. So we do what we call pre-engagement activities. Right. So in terms of this, now we're evaluating, all right, if we should accept the client or not. Right. That's the pre-engagement activity. So normally what happens now during the pre-engagement activity, you're evaluating. All right, there's a lot of factors that you need to consider in regards to this evaluation. So in terms of this, the first thing, all right, that you can evaluate, it could be integrity of management, all right, of the client, integrity of the management. So in regards to this, as an auditor, you do not want to be much associated with a client that has a lot of scandals, or a client that does not respect the laws. All right. So in terms of this, so you evaluate based on the integrity of the management that's within the client. All right. So in terms of this, just to give you a small example, I believe you guys, probably not sure where you were, but I'm sure you've heard around about 2016, 2017, 2015, somewhere there. There were scandals around. There's an audit firm that used to be called Nkonki, all right? And then I'm sure you guys know about the Guptas, and then I'm sure you guys know about KPMG. All right, so back then, what used to happen now is so Nkonki, it was a small to medium audit firm. So the management sold, right? They sold the firm to some other guy, right? And then, I mean, the directors, I mean, they sold the firm. And then after selling the firm, so the Nkonki firm now accepted an audit, right, of a client that was actually owned by the Guptas, all right? And then they issued an unqualified audit report, right, to the Gupta's company. And then later on, it was discovered now. I'm sure everybody knows about the scandals that came in with the Guptas. And then the next thing, actually, in Gong is now history, right? It's no longer exist. It had to shut down. So that's actually the problem that comes with evaluation with regards to integrity of the management of the client that you're auditing. So if you're not careful with regards to that evaluation, you might find yourself in deep trouble. All right. So that's the first thing. So when you talk about integrity, you need to, when you're answering questions, all right, during the assessment, if there's a question saying, evaluate the pre-engagement activities, all right, with regards to the client, so you assess the integrity of the client. So this information you find based on the background information or the information that they can give you. So if you find that the client is involved in, maybe they're involved in bribes, all right, or any sort of such transactions, then you have to list it down that the integrity of the management is questionable as they're involved in issuing of bribes and all that. Right. So that's that.
Yeah.
Okay, cool. And then the next, yes, sir.
No, I said yes, sir.
Oh,
Sorry.
okay. And then the next thing is availability of a vacancy. Availability of a vacancy. All right. So now the general norm is you cannot appoint two auditors at the same time, right? So now, in order for the audit firm to be appointed as the auditor, the previous auditors, you have to terminate the agreement or the arrangement that you have with those ones. So you have to, before you accept an engagement with a new client, you need to evaluate, is there a vacance? Does a vacance really exist? All right, in regards to this audit. All right, so it's quite important that you evaluate that. Then ability to pay audit fees. All right, so in terms of this, you need to assess, is the client that we're auditing in a position to actually pay us the audit fee? All right, sometimes you find that the client is going through financial challenges. Maybe they're making losses, all right, or they're going through business rescue. So it's a concern in regards to that. Are they going to be able to pay the audit fees? Or maybe you find that the previous auditors, they were not paid. There are some clients have that history whereby they do not want to pay the auditor. So you need to evaluate with regards to that. Are they going to be able to pay you them? All right. And then independence and objectivity. So with regards to this, all right, as auditors, you need to audit a client whereby you're actually independent. All right, in regards to this, remember now, if you're not independent now, that means now the audit is actually shrewd. So in regards to this now, it's no longer a clear audit, because now the idea that comes with regards to auditors, it means everything should be performed independently. So with regards to the independence, you need to consider also there could be threats that comes with regards to this. So maybe there's a relationship that involved within possibly maybe the audit manager, all right, or the audit partner that could be involved with the management of the client. Maybe they're family members, they're friends, they have a long-term relationship, all right? So you need to state when you're answering your question now to say you can have a heading to say independence and objectivity, then you state that maybe the audit partner, you give the name, all right, is related to the company CEO, all right? So you state. So state the relationship between audit member and the client and the client, all right? You state the relationship, then you can state the significance. How significance of the relationship to the audit. All right, so you need to state how the relationship is significant. Say, for example, maybe you are related to someone who's involved in drafting the financials, all right? And this regard, that means now the threat is very significant, since maybe the CFO is involved in preparing the financial statements, all right? And then with regards to that, you also need to state, all right, the type of threats involved, right? You can state the type of threats involved. So when we talk about threats, we are looking at familiarity threat, all right? We're looking at self-interest threat. We're looking at self-review threat, all right? We have self-interest, there's advocacy threat, all right? And so forth. So I need to discuss what type of threat is involved with regards to that. All right, then you can state the safeguard that you can be implemented. So by safeguard, we're saying, okay, there's a threat that's involved with regards to this client. Now, what safeguard can we implement? By safeguard, now we're saying what measures can we have in place, right, with regards to this, or what solution do we have in place? So in terms of, let's just say solution, all right, to make it a bit easier. All right, so what solution can you have? So the most common solution or the safeguard is to remove the audit member, all right, the one who is actually not independent. We can remove them from the audit, all right, so possibly remove the audit member from the audit. All right. So in regards to this, if it's a partner, all right. And now the problem with partners, if it's a small firm, right? We know with small firms, sometimes it has one partner. Now, with the moment we remove the partner, there's no one to sign the financial. You see where the problem could be. So you need also to evaluate if it's a firm with only one partner, you can't remove the partner. All right. What you can only do is to reject the audit. All right. So you reject the engagement. All right. So in regards to this, in cases whereby the threat is very significant, you then have to reject the audit. All right. And then we have availability of resources. Resources, skills, and competence. to perform the audit. All right, so before you conduct an audit, all right, or you accept an audit, you need to evaluate. We have the resources, all right? So in terms of resources, we are looking at, do we have the means, all right? Do we have enough staff members, all right, or audit team members? Do we have enough resources to allocate to the audit, all right? If it's an audit, probably it's an audit outside of the country or it's an audit in another province. Do we have the funds, all right, to travel to that client, right? So in regards to this, that's availability of resources. And also in terms of competence, all right, do we have skilled audit team members, all right, to carry out the audit? Sometimes you find that maybe it's an audit that is in an industry that you're not familiar with, all right? Now, in that case, that means you're not competent to conduct the audit, all right? So now, do you have now the resources to engage probably an expert in the industry that you want to audit? All right, so in regards to this, those are the factors that you look at before you accept an audit client. But we'll look at some questions that are about pre-engagement activities there. All right, so that's the first step that we have with regards to an audit. All right, then the next step now, once we have accepted the engagement, all right, we have signed the engagement letter. Now we're now going to be conducting an audit. All right, so what we then do now, we then have to come up with planning and risk assessment. Right, let's start off with risk assessment. All right. So in terms of risk assessment, I'm going to share with you, there's a document that I have to do with risk assessment. All right, so it writes down some triggers that kick in regards to this. All right, so let's quickly look at it so that we can see now what's happening. So you find now that the questions, all right, that will be asked about risk at overall financial statement level. All right, so it's very important in regards to that we're in a position to answer those questions and accumulate all the marks. All right, so in terms of answering questions at risk at overall financial statement level, and I believe if a question asked about risk at overall financial statement level, which I'm going to share with you, the triggers that kick in with regards to risk at overall financial statement level, I think everyone should be able to collect all the marks, all right, when a question is being examined about risk at overall financial statement level. Why? Because the questions on risk at overall financial statement level is a concept of just identifying the triggers. Once you identify the triggers, then remember you have studied or you have memorized all the possible type of risk at overall financial statement level. So in regards to this, then you should be able to answer the question. All right, so in terms of this, what's happening? Risk at overall financial statement level. You found that the document that I shared with you, there is risk indicator. Now, what is risk indicator? All right, these are factors that you find in the scenario. All right, these are factors you find in the scenario. Right, what is happening in regards to this one? Right, you find out that sometimes they can tell you that the company operates, right, or they import raw materials in China, just as an example. Now, that's a risk indicator. You're buying material in China, all right? So in terms of this, so the moment you see that, oh, the client is buying material in China, all right? In regards to this, what do you know about China now? Right? So in terms of this, now you can have an understanding how to say, okay, so the fact that now they're buying material in China may probably, all right, China nowadays, they use a different currency to the South African rand, all right, which means now they have to translate, all right? There's lots of translation in regards to this. Let's look at purchase of material in a foreign country. purchase or sell, right, in foreign country. So what type of risk that's involved? There is IS-21, right? The translation, right? It's a bit complex. There's a risk of incorrect exchange rates, right? That's being used in regards to this. Right? So you have to state now that the fact that probably there is now that. So there's a risk that material mistake due to error. All right. So let's look at it. So when you're designing a risk at the overall financial statement level, your sentence should start like this. State that the annual financial statement, all right, or you can just use AFS. All right. Annual financial statement, you can say might be materially misstated. Right? The annual financial statements might be materially misstated due to error. Right? You state due to error. Right? Why do you think it's an error? Then you can state as the company purchased material in China, and there's a risk of incorrect exchange rate being used. All right? In this regard, you see, so you've identified now in regards to this. There's a risk of incorrect exchange rate being used, so you get your mark. So when you're designing the risk at overall financial statement level, your sentence should always start like this. All right? So these are the parts. You can have materially misstated due to, right? It can be due to error. It can be due to fraud, all right? In regards to this, all right? So that's what we have in regards to this. So it can be due to control environment, all right? So in regards to this, that's what we have in regards to the risk, overall risk at financial statement level. So always look at the trigger, then you identify how you're going to discuss your risk there. All right, so I want you guys, all right, to run through the document that I shared with you. All right, so in regards to this, if you see that the company is listed on the JSE, all right, you should understand that this is also a risk. All right, if a client is listed on the JSE, it's a risk. How is it a risk? All right, remember you're listed on the JSE. That means now you are actually subject to JSE compliance. All right. Now, in order for you to comply, what do you do? Sometimes you're not meeting the requirements. So what do you do in order to comply? You find that companies, in some instances now, they can overstate the assets and the income so that they can meet the JSE listing requirements. Remember, there's a certain profit that you need. There's also a certain number of assets that you need. So what do you do in regards to this? You overstate the assets. So that's the risk with being listed on the JSE. You know, there's a risk that the company might actually inflate, you know, its assets and liabilities. All right, so in regards to this, all right, to write down that, you can just say the annual financial statement might be materially misstated, all right, as the entity is actually listed on the JSE, all right, and then you state now that the company might not comply with JSE listing requirements, all right, as they will be forced now to inflate the assets and the income, all right? So in regards to this, that's how you can describe your risk there, all right? So once you have described your risk, all right, you've assessed your risk there, then the next thing, all right, with regards to this now, I should do audit planning. Right now, what's happening under audit planning? So under audit planning, you're evaluating, you now need to allocate the different staff members to different sections of the audit. Remember, you're sitting in now with revenue, expenses, and so forth. So you need to allocate every staff member to each and every one of those sections. So what you do is you can do materiality and calculate what we call planning materiality. Right, what is going on in terms of planning materiality? So on planning materiality now, we're identifying the amounts that we need to pay attention to. All right. So in terms of this, so you're saying, okay, all amounts that are above planning materiality, we need to audit. All right. So all amounts above planning materiality needs to be audited. All right. So all amounts on the sample. All right. Remember, we audit with sample. All right. All amounts on the sample above planning materiality needs to be audited. Now, what does it mean? If our planning materiality is 5,000, that means now the balances or the amounts which are above 5,000, right, in regards to this, we need now to audit those balances. So that's how it works with regards to planning materialities. Now, the calculation of planning materiality. Right, let's look at that part. How we calculate planning materiality and so forth. All right. So in terms of the calculation of planning materiality, all right, they then say, all right, in regards to this, we need to identify, all right, we need to identify the factors, all right, or the triggers that we have with regards to planning materiality. All right. So in terms of this, we are looking now at what is the core business activity of the client. Let's take, for example, if you're auditing a client that is in properties, investment property. So you know that a client is involved in investment property. We can agree now that the best that we can use for planning method is more likely that it's assets, right? Because the company is involved, it is actually involved in buying more properties, all right? So the best that we can use in regards to this, it will be mostly the assets, because that's what the company is heavily invested in. And then we have clients that is in the retail industry, like Pick and Pay, Checkers, and so forth. So you find those clients, they do lots of sales, right? I'm sure you guys agree with me. There's lots of sales transaction. They sell a lot of small items almost every day. Now, when you are calculating planning materiality, you agree with me that it's more ideal, right, to start to have the trigger, right, or to base the materiality on revenue, right? You can have it on revenue, or you can have it on gross profit, or you can have it on net profit, right? You're planning materiality in regards to this. So the first thing when identifying planning materiality, all right, identify the driver or core business activity within a company. Right? So that's what you need to first identify before you start calculation of planning materiality. Then the next thing, all right, with regards to planning materiality, all right, you have identified your driver. The next thing is to assess level of risk. Right. If risk is high, materiality is set as low. Right? Now, what is the logic behind this? So we're saying if the client is high risk, right? High risk, it means now there's a high chance that there are misstatements in the financial statement. But misstatements, we are looking at it to say there's a high chance that not everything is done accordingly. All right. So that's what you call misstatement. So if there is high misstatements, so what we can do now is we need to test as many items as possible. All right. So we set materiality as low. Remember, we said materiality, we're looking at the amounts that needs to be audited. Imagine we set materiality high. It means now we're going to audit only high amounts. You see where the problem. So if risk is high, it means we need to pay attention to almost every transaction. So we set our materiality at low amount. If risk is low, materiality is set at high amounts. Right? So you choose the higher range with regards to setting your materiality. What's the logic? Everything is fine within the client, all right? It's a lower risk, so there's no need for us to stress much about setting our paying attention to many items, because you know that the client is actually doing quite well there. All right, so basically that's what we have with regards to the calculation of materiality there. All right, the next thing now, all right, let's look at with regards to materiality, what figures should we use? Right, so in terms of this, we have current year financial statement versus budgeted financial statement versus prior year audited financial statement. Right, so which figures should we use to calculate our materiality? Right, the first figures to consider, first consider current year financial statements. Right, those are the figures that we use when calculating planning materiality. We consider the current year financial statements. But if there is lots of misstatement, all right, so in regards to this, if you find that probably there was fraud involved, all right, in the current year, all right, if there's fraud involved, or probably they used a junior accountant, all right, in drafting the financial statement. In that case, it means we cannot place a reliance now on the current year financial statements, all right? In that case, we cannot place reliance on current year financial statement. So what do? We then look at budgeted financial statement. All right, we then use budgeted financial statements if they are available. All right, now on budgeted financial statement, if the budget is way different to actual, or probably there's fraud involved as well. All right, or unreasonable assumptions used to prepare the budget. Right? If they use unreasonable assumptions to prepare the budget, in that case, we then use prior year audited financial statements. All right. So basically, that is how we determine planning materiality. All right. So into there's something that I skipped in regards to this. All right. When determining this, all right, in terms of this, all right, if there's a loss or fraud in amounts, we cannot use those amounts as a base for materiality. Now let's take, for example, if a company made a loss during the current financial year, remember you want to determine planning materiality. That means now if a company made a loss in the current year, that's to say now we are not going to use those figures to calculate materiality. Yeah. Sometimes in the exam, they need you to give them reasons, all right, with regards to the calculation of material planning materiality. So it's quite important that you're in a position to explain these factors. All right, they can examine that type of a question there. All right, then, so you've calculated your planning materiality, all right, and then now you want to engage in an audit, all right. So the next step is to do test of controls, all right. So under test of controls, all right, with regards to a client now, we want to evaluate, all right? In terms of this, all right, I want to look at it to see now what's happening in terms of this, all right? So on the test of controls, what's going on now is we're identifying if the controls in place are working efficiently, right? Now, when you talk about controls, right, we are looking at the systems that the company has in place. All right. So in terms of this, I'm sure you guys have done some cycles. All right. So in terms of the systems, let's take, for example, on the payroll. All right. How do we know that the payroll is actually accurate? So you find that the client, they'll tell you that, okay, so when an employee, all right, when an employee gets to the entrance point, they have to insert a fingerprint, right? Or it can be a facial recognition system, whatever system that they have, or the turnaround system, whatever they have. So at the entrance point, they said, okay, we use a biometrical system where the employee has to insert the fingerprint, and then they can access is granted. All right. So in regards to this, to clocking in, you have to insert the fingerprint. All right. And then when you're exiting the points, the employee also has to insert their fingerprints, and then the information is sent to the HR department, and then they capture the hours worked during the day. All right. So those are controls that they can have in place. Now, as an auditor, all right, now to test if this system actually works, what do? All right, you can possibly make use of, probably can request one of the employees, all right, to actually insert their biometric, all right, or their fingerprint into the system, and then you can actually evaluate if the information is sent to the HR department. So if you find out, oh, the information was never sent, then you know that, oh, there's actually more function within this control. All right. But if the information is sent, then you know that, oh, actually, it actually works effectively. All right. So there's a whole lot of things, for example, banking. All right. The client will tell you that before we bank the money, all right, there's 2 signatures that authorize the banking. All right. So maybe the withdrawal, whatever the case is. So there's 2 signatures that needs to be put in place. All right. So as an auditor, you evaluate. All right, you can inspect, right, if those 2 signatures were actually there before any form of withdrawal takes place. If you find out that, no, there's actually no signatures, all right, in regards to that, then you know there's a weakness within the company. All right, so we have test of controls. Now, test of controls also determines the type of audit approach, or what we call audit planning. All right, the results of test of controls, it affects audit planning. Now, if test of controls are working effectively, right, if they're working effectively, the audit approach, right, by audit approach, you're saying, how are you then now going to be auditing this client? All right, how are you going to be auditing this client? Because the tests of controls are actually working. So which means now the audit approach that you have to use, we're going to use test of controls, the reliance on test of controls. And substantive procedures. So we call this a combined audit approach. Right? So if test of controls are working effectively, we do what we call a combined audit approach. So a combined audit approach is whereby you are carrying out the audit, right, in such a way that you are relying on the test of controls and substantive procedure. So sometimes in the exams, right, they can ask you, right, what is the auditor's response? Right? How is this going to affect the auditor's response? Right? So in regards to this, right, let's look at it, right, to see now what's going to happen in terms of this. Right? So what then happen is we then have to look at, right, if, right, in terms of this, if there is a combined approach, that means now we are going to conduct what we call smaller sample size. Right? So there's low risk. Right? So in this case, if there's low risk client, right? So audit response, right? You can, in terms of this, if it's a low risk client, you can use smaller or sample size. Right? Remember you say no, there's actually lower risk in regards to the client there. So the audit approach in regards to this, you can use smaller sample size. Right. And then if test of controls are not working effectively, right? Test of controls are not working effectively. It means now we have to conduct more substantive procedures and less reliance on test of controls. Right? So when you're conducting an audit, we're having less reliance on the information they provide us with regards to test of controls. All right. So in terms of this, all right, what is the auditor's the effect of this on the audit approach? All right. So you find out now that there's controls can be relied on. So in terms of this, we increase sample size. All right, we need to test as many items as possible, so we increase the sample size with regards to the audit. All right, and then if the client is a high risk client, we can also, in terms of audit approach, we can appoint, all right, assign more experienced, or assign experienced or senior. Let's just say experienced audit team members. All right, so in regards to this, find that the client is actually an high-risk client. So what do? You assign experienced audit team members, all right? Engage audit experts, right? You can work with audit experts in regards to this, right? So these are some of the things that we can look at in terms of the audit, all right? So that's what we have, all right? And then we have some questions, all right, in terms of an audit. We're also looking at audit approach. If there's a tight audit deadline, all right, so sometimes you find there's a tight audit deadline. So what is the audit approach that you can use in regards to this? All right, you can conduct interim audit and roll forward. Year end. Right, what is that? Right, so a tight audit deadline, this is whereby the client, they inform you that we need the audit probably maybe 1 month after year end or 2 months after year end. But you find that most cases in terms of tight audit deadline is where the client is telling you the date that they need the audit. All right, so as auditors now, right, in regards to this, what you then do, all right, if they find that the client needs the information a few days after year end, so you do what you call interim audit. So what is an interim audit? An interim audit is whereby now, as auditors, all right, as auditors, you then conduct an audit before year end. Probably you can conduct an audit maybe 6 months from beginning of the year, or it can be 8 months, or even the number of months, as long as it's before year end. So you audit the first maybe half of the figures before year end. all right, or 8 months of the figures before year end. So you audit those amounts, all right? So once you audit those amounts and then come year end, all right? So you then audit the remaining amounts. So let's say, for example, in the interim audit, we audited the first 8 months. All right, so we audited the revenue for the first 8 months, the expenses, assets, liabilities, and so forth for the first 8 months. Then we come to the year end. All right, we're going to audit the figures now for the remaining four months. All right, that's what we call an interim audit. This saves us time. All right, because remember we have a tight audit deadline. So that's what we can do in regards to tight audit deadline. In response to a tight audit deadline, we can conduct an interim audit there. All right. So that's basically what we have in regards to this. Right, now let's look at substantive procedures. Substantive procedures. Now, in terms of substantive procedures, all right, this carries a lot of weight, all right, in terms of the exam. It's very important, all right, that we know what's happening in regards to the substantive procedure. They really want you to know this, because substantive procedure, this is actually auditing. All right. So in terms of substantive procedures, right, you need to understand now that we deal with what we call assertions. All right, we need to understand assertions. Right. Now, assertions now, they help us to determine what exactly are we looking for. All right, we have different types of assertion. This is governed by ISO 315. All right, 315, it governs assertions. It talks about the risk. All right, so in terms of this, assertions now, all right, we have different type of assertions. We have assertions for account balances. All right, that's more or less like assertion for the statement of profit and loss. All right, items, and then we have assertion for statement of financial position items. All right, so for statement of profit and loss item, which is income and expenses. All right, just going to give you a few. All right, so we have what we call completeness. Completeness. All right, what is this assertion about? All right, so in terms of this, right, with regards to completeness, we're saying, did we record all transactions that we should have recorded? Recorded. Now, remember, we're linking the assertion to the substantive process. So if you see a question, right, and then they're asking you, design the substantive procedures on the completeness of revenue. All right, you need to understand what they want us to test. Did we record all revenue transactions that we should have recorded? So now, completeness. Right, when the question asks you for completeness substantive procedure, you need to understand direction of testing is very important. Right, that is why now sometimes you find that you write an exam, you write 8 pages, 10 pages for the exam, but unfortunately you get a lower mark. Right, so probably your direction of testing was incorrect. All right, that's what we have now when we talk about substantive procedure. Now, what do you mean by direction of testing? Remember, we say, did we record all transactions that we should have recorded? So which means now your direction of testing, all right, we're coming from source documents to accounting records. So it means now, remember, you have the samples, all right? You have the samples, all right? You've you have selected a sample of invoices, all right? So in regards to this, it means now with direction of testing, you're coming from the invoices. Then you go to the general ledger accounts. Then you go to the financial statements. Then you go to the trial balance and so forth. So that's what we call direction of testing. So you find that maybe you record inspect, all right? Or agree, all right? Inspect the invoice amount. Inspect the invoice amount, all right? And confirm if the invoice amount, or you confirm if the amount is recorded in the general ledger. Right, do you see? So in regards to this, what is happening? Inspect the invoice amount or inspect the invoice transaction. Now, what is the direction of testing? You're starting from the invoice, which is your source documents. Then you're going to general ledger. What is the general ledger? This is your accounting record. You see, so it's quite important. It's different. If a question is asking you for substantive procedures on completeness of revenue, now, and then somebody now start off by saying, inspect the general ledger amount and agree the amount and confirm the amount with the amount in the invoice, it's completely wrong. Why? Because now this person is no longer testing for completeness. They're now testing for occurrence. Do you see? So it's quite important when you're designing your substantive procedures that you know the direction of testing. Right. So that's that with regards to completeness. Of course, we're going to look at different examples that kick in with regards to completeness procedure. Then we have occurrence. Right. Now, what's happening, right, in terms of occurrence as part of our procedure there. All right. So in terms of occurrence now, what is going on now with regards to this one? We are saying, all right, all transaction recorded, did they occur? Right? Or in other words, did they take place? Right. So for example, all right, remember auditing is mostly your auditing accounting. So you're saying, all right, what the accountant recorded, all right, did it actually take place? For example, revenue. You know, remember, for you to record revenue in the accounting records, you should have transferred control to the customer. All right, so sometimes it does happen that before control is transferred to the customer, you find that the client already they want to record the amount as revenue because they've received it. They want to record it as revenue, but as auditors now are saying, no, what does accounting say? They say revenue is recognized if it meets those 5-step approach. All right, remember, start off with, first one is identifying a contract. The second one is performance obligation, transaction price, allocation of transaction price, and revenue recognition. Does it meet those 5 steps? So that's what we have with regards to occurrence, which means now when you're testing for occurrence, direction of testing is the opposite of completeness. So in terms of this now, your direction of testing now you're studying from accounting records. Right? By accounting records, you're looking at why the accountant captured. It can be journal entries, it can be general ledger, it can be the financial statement, it can be the trial balance. All those items are accounting records. All right, so accounting records, and then you're testing to source documents. So by source documents, we're looking at where the transaction originally started. That's occurrence. All right. So in terms of this, it's quite important that when you're testing for this, you understand that. Now, here now, that's where you have inspect the general ledger amount or transaction, whatever that you have, and agree to, or agree the date, whatever you want to agree to the, maybe the invoice amount. All right. Do you see? So in terms of this, you're looking at the direction of testing, which is the general ledger. This is accounting. Right? And then you're going to invoice, which is your source document. So that's the important with regards to direction of testing. Anyways, in terms of testing, right, these are the 3 elements which are quite important now when we're dealing with substantive procedures. When you're testing for cutoff, remember cutoff, you're testing if we recorded the transaction in the correct accounting period. There's no direction of testing. When you're testing for accuracy, there's no direction of testing as well. All right, accuracy cutoff. Classification, all right? No direction of testing. These assertions. Right, there's no need to worry about direction of testing. The worry about direction of testing when I take even procedures on occurrence. Occurrence is also called existence. All right, so in the statement of financial position, occurrence, we call it existence there. All right, so basically that's what we have. Now let's look at how do we design substantive procedures. All right, the designing of substantive procedures. I'm sure you guys have heard of how, what, and why. All right, so it's quite important, all right, in regards to this, all right, so when you're designing substantive procedures, you need to state the source of information, all right? Where are you getting the information you're testing? Right? Then it's important. You need to state, all right? That's what, all right? That is the what part. You need to state where you're getting the information. If it's invoice, all right, you need to state invoice, all right? General ledger, fixed asset register, and so forth, right? So you'll find those ones mostly in this scenario. So you need to always tell them where are you getting the information that you are testing, right? And then how. So in regards to this now, it's quite important in designing substantive procedure that you look at the how part. So you look at auditing verbs, all right? Now here, this is where you look at words like observe, agree, inspect, all right? Confirm, discuss, all right? And so forth. So this is now you conducting this procedure. You need to be in a position to tell them how are you conducting these procedures in regards to an audit. All right. Questions are in terms of this. And then why? All right, I hope you guys will be designing your questions. Then why? Right, we are looking at the assertion now. All right. So in this case, you can agree. All right, the invoice amount, agree the invoice amount to the general ledger. Why agreeing this? To confirm if the amounts were captured correctly, to confirm if the balance is accurate, and so forth. So in terms of this, the reason why you're performing this procedure, right, is because of those assertions. Did the revenue actually occur? All right. So we'll look at those ones when we're designing our procedure. Then we have general substantive procedures. These ones you cannot afford to miss. Right? When you're designing substantive procedures, you cannot afford to miss the general substantive procedures, right? Because these ones, they almost apply in almost each and every aspect. All right, what do we have there? All right, so in terms of the general, you can first obtain management representation letter. Right, obtain management representation letter regarding, in this case, you state the type of assertion that you're testing. Right? If there's completeness, obtain management representation letter regarding the completeness of revenue. If the question just say perform substantive procedure on revenue, you can say obtain management representation letter regarding all assertions on revenue. All right. So in regards to this, that's how you design your procedures in terms of this part of the question there. All right. So basically, that is what we have, and that's how we go about it when you're designing the procedures there. All right. That's what we have in terms of substantive procedure. Let's just quickly touch a little. Well, let's just do reporting on the next class. All right. Any questions, guys?
I said it looks so easy when you do it. I think it's just understanding what they're asking maybe and just answering the way they want us to answer. I think that is my biggest mistake. Because sometimes I write just a load of nonsense, and then maybe that's not even what they wanted, but I just want to fill my page to get as much answers as possible. So I think that's maybe where I was struggling. If I see how you put it out, I think my method of learning was just wrong. But hopefully with the guidance that you gave us now and we do test, then I can at least train my brain to answer every single thing that they ask us to do in the way that they want us to do. So I think that's my biggest thing maybe. So yeah.
Okay. All right, that's fine. So the next task now, so audit, like we mentioned earlier on, that audit is also about answering the right way. So the next step now that we need to look at now, because everyone needs a vision of what's happening in terms of audit, is now for us to practice examples. So we're going to be looking at questions, right? I did share with you a pack there, past papers with solutions. So try to attempt that. Sit on that one and then see how they answer the questions and how they answer. But we're going to be using that document as well in preparation for the SAP exam there. All right, and also, just another thing I noticed that sometimes on the SAP, they love testing CICA papers. You know, so I'm going to look at, I'll try to download for you guys the ITC paper that was written this year, right? And then we can just look at the relevant sections there, just here and there, not everything, but I've seen them. They can ask about 50 marks or 60 marks coming from ITC. But I'm not saying that's what's going to happen, but I've seen it happening. I think it's twice or three times they've examined that on the supplementary exam. So you're just going to be safe. We'll look at those ones and then see how it goes there. All right. Any other questions, guys? Or suggestions?
No, sir. So are we going to have the next class like we have on the timetable? So it's Saturday, if I'm not mistaken.
Yes. Yes. So we're going to stick to that timetable now for now.
Okay. Must we prepare something for you for the class, maybe for the next class? Maybe look at one test, or how do you want us to go?
I'll tell you which question to look at. So on that document that I shared, I'll just tell you which question you can run through. Yes.
Okay, cool. Thank you, sir. Appreciate it. And when you share this document with us as well, just to look at again.
Yes, we'll look at it. Yes, we'll look at the question. So I'll tell you in advance which question you should attempt, and then we'll discuss it in class. Yes.
Thanks, sir.
All right. Any other questions, guys? All right, cool. If there are no questions, I can say Happy New Year, guys. All right, we just a few hours ahead, but I believe you guys will make it. All right. Let's hope 2025 will be way better than 2024. Have a good evening, guys.
Thank you, sir. Have a blessed and safe new year, eh? And thank you for all your help. We appreciate it. Thank you, sir. Enjoy the day. Cheers. Bye.
Bye.
Thank you a lot for taking your time.
It's a pleasure. Thanks. All right, bye.